Many people ask their parents or others on how much is needed to buy a home. Specifically, the older generations have a viewpoint that might not be as accurate today. Their viewpoint is that you should not consider buying a home unless you have 20% down payment. And of course, you've accumulated at least 6 months worth of savings. If this is true, homeownership can seem like a distant dream for you. So is the 20% rule absolutely necessary? How do you determine the percentage that is feasible for you? Hi, I'm Adam House. I'm a realtor in Chicagoland. And let's clarify something crucial before we dive deeper into this world of homeownership. It's essential to understand that there's a distinct difference between being financially capable of buying a home and buying one wisely. Being financially capable implies that you have the necessary funds to cover the costs associated with purchasing a house. This involves not only the obvious ones, such as the down payment and mortgage payments, but also other less visible expenses like property taxes, homeowners insurance, and maintenance costs. However, the ability to buy doesn't necessarily mean that it's the right time for you to do so, or that you're doing it the right way. Buying wisely means you're making a financially sound decision that aligns with your long-term goals, your lifestyle needs, and your financial security. It's about considering the bigger picture and thinking about how this decision impacts your financial health in the long run. Contrary to what maybe your relatives are telling you and their beliefs, a 20% down payment is not the absolute requirement to buy a house, even though it's often seen as a traditional benchmark. But there are many loan programs available today that allow for lower down payments. There's a minimum figure that can be determined, which could be as low as 0% in some cases. Anything beyond that minimum is subjective, and it depends on your personal financial situation, your risk tolerance, and any long-term plans you have. Consider the down payment as a sliding scale rather than a fixed figure. While a large down payment reduces your monthly mortgage payment and potentially eliminates the need for private mortgage insurance, which I will talk about a little bit later, it also ties up more of your money into the home. If this leaves you without a sufficient emergency fund or inhibits your ability to meet other financial goals that you might have for yourself, then that larger down payment could prove to be a kind of a risky move for you. Remember that homeownership is more than just securing a roof over your head. It's a major financial decision that requires thoughtful planning, considerations, and a fair dose of financial wisdom as well. Therefore, it's crucial to understand your own financial situation and also seek advice that is tailored to your needs and your circumstances. Also, if you have any additional tips or questions, put them in the comments. I might miss something along the way as well, and I'm curious to see what your guys' experiences are. On this channel, my objective is to educate you first and then empower you to make the decisions that are best for your circumstances. Now let's get down to business. The first thing you should consider when buying a house is financing. Clearly, you're going to need a loan, and there will be certain costs associated with the terms of that loan, particularly the down payment. The minimum down payment required to buy a home can actually be as little as 0. Thanks to various loan programs, you have USDA and VA loans for veterans, as well as numerous first-time homebuyer grants and down payment assistance programs. These can actually significantly reduce your down payment even down to 0, which would be called 100% financing. For most people, the least you'll have to save for a down payment is about 3 to 3.5%. However, not everyone's going to qualify for these programs due to income or any other area restrictions they might find. The most common financing option you'll come across is the FHA or Federal Housing Administration loan, which requires a minimum of 3.5% down. This program, which is backed by the US government, is known for its comparatively low eligibility requirements. Unlike conventional loans that often require a substantial down payment, FHA loans require a minimum of just 3.5%. This lower threshold is designed to encourage and make homeownership feasible for a wider segment of the population, especially first-time homebuyers or those with less than perfect credit. However, it's essential to remember that these loans come with their own set of criteria and limitations, which must be fully understood before making any type of decision on them. Then there's conventional financing, which is more of a traditional bank loan, with a minimum down payment that can be as low as 5%, but it can go as high as 20% or more. The reason why many people suggest a 20% down payment in the first place is because it eliminates PMI or private mortgage insurance, and it may offer better interest rate terms as well. PMI is an additional fee that home buyers are required to pay when they can't afford a 20% down payment on their mortgage. Basically, it's a type of protection that lenders require from buyers who are deemed to be a little higher risk due to their lower initial investment in the home. The PMI coverage compensates the lender if the borrower defaults on the mortgage. It's important for me to mention here that PMI does not benefit the homeowner in any way, but rather the lender by making an extra expense that many potential homeowners aim to avoid. However, once the homeowner builds up to at least 20% equity in the house, they can typically apply to have the PMI removed through their lender. Down payment aside, there are numerous other costs you might consider when buying a house. One of the most significant being closing costs. On average, these costs hover around 2% of the property's price, although they can sometimes reach up to 5% depending on your location and complexity of the transaction. Closing costs are home, pun intended, to a wide array of fees that are associated with the process of buying a house. These costs are charged by various parties involved in the transaction. Your real estate agent, for example, earns their commission from the sale, which is part of the closing costs. Similarly, your lender will charge a fee for initiating and processing your loan. These costs can include, but are not limited to, your loan origination fees, credit report fees, appraisal, title search, title insurance, your survey, deed recording fees, and underwriting fees as well. Additionally, you may also have to pay for escrow deposits for property taxes and homeowners insurance, which are held in an account for you and then paid out when they're due. It's also important to remember that while many of these costs are fixed, some of them are negotiable as well. For instance, you might be able to shop around for better or cheaper homeowners insurance rates or attorney fees and other things like that. Having a clear understanding of these costs is vital to avoid any unpleasant surprises when finalizing the purchase of your home. Also remember there are fees that aren't included in your closing sheet but are necessary when buying a house. Some of these fees are due up front and not at closing. These include a home inspection, which can cost around $400 to $600 depending on the size of the house and other things, and any additional inspections that you might want to do if there's radon or termites and stuff like that. Also, you have to account for the appraisal, which can be up to around $700. Plan on adding another maybe $2,000 or more for these expenses as well. So mainly there are three primary categories you should focus on when saving for a home: the down payment, the closing costs, and the miscellaneous additional fees. Each category is a substantial part of the home buying process and it needs careful consideration. For instance, if you're looking to buy a $300,000 home and you're planning to make a 3.5% down payment, you need to save approximately $10,500 just for the down payment. On the flip side, if you're planning to make a down payment of 20%, which is often recommended to avoid the PMI that I spoke about, and it can also possibly help you secure more favorable loan terms, you would need to save a hefty sum of about $60,000 for that. It's also hugely important to have a buffer for unseen expenses or income disruptions. Many financial advisors recommend having at least 6 months worth of savings in an emergency fund. This approach is often overlooked, but it should also play a very major role in your planning to buy a home. In conclusion, when planning your saving strategy for buying a home, it's crucial to look at the big picture. Consider all the costs involved, not just the down payment, and be prepared for the unexpected. A well thought out plan will help you navigate the path to homeownership more comfortably and securely. Remember, advice from older generations often comes with good intentions, but it may not always align with current realities. Ask yourself what you can afford. Have your 3 to 6 months reserves saved up and evaluate the housing market in your area. Don't let the dream of homeownership just remain a dream. Don't be a renter forever if there's something you can do about it. Start preparing today for the reality of tomorrow. And that's all for this one. If you need any help, I have access to realtors all over the US and other countries. If you're in Chicagoland though, don't hesitate to reach out to me if you need anything. If you found this video helpful, don't forget to hit the like button, and also again, leave any comments or tips or questions down below, because I am curious to see what you guys have seen out there. Alright, see you in the next video.